We've certainly seen that fixed income assets so far this year have seen quite a fast and furious repricing, haven't they? Do you feel that what we're seeing in terms of pricing now is getting it right?
Absolutely. If you remember that the investment community actually have been complaining about yield being too low for too long over 18 months, and now yield has risen and spreads have widened, and fixed income assets have repriced aggressively year to date. So we actually started to see that the value started to emerge in fixed income assets. Forward-looking returns on fixed income assets can be quite tempting at the moment. If we think about Asia, for example, taking Asia as an example, if we look at the Asian investment grade, it's yielding at more than 5%. That's investment grade we're talking about here.
Jenny, what is the shape of that curve telling you about the investment expectations of the Treasury market? The inflation expectations, rather.
So far, the curve remains reasonably flat, but it hasn't really. We have to be careful thinking about what's the implication of a flattened curve. In history, yes, a flattening curve does have implications in terms of future growth, in terms of recession risk. But the difference this time is that we don't really see that imbalances, no matter on the corporate or on the household balance sheet. So that lowers the probability of having an immediate shock on the economy. And therefore, yes, the curve is flattened, which means the risk of a recession is picking up, but now there's not at the point that need to be alarmed yet.